Like most companies today, you need money to grow your business. Maybe it's for an acquisition, possibly to finance a new product line, promote accounts receivable growth or inventory growth, or just reverse a negative trend or cover some temporary negative cash flow or deal with some tardy receivables where people are not paying you on time. Back in the old days, people would say, well, just go to the bank. Ladies and gentlemen, for all intents and purposes, the banks are closed to you and me. After the trauma of 2010, banks are not motivated to make loans, and if they are, they're cautious, and they want personal guarantees, and they want you to pledge your firstborn. We think you need to go beyond the banks. And so the next source is called an asset-based lender. Here people are more reticent to lend on a formula basis, typically 80% against eligible receivables and 40 or 50% against eligible inventory. The lender is safe because they have collateral, and you now can grow as your borrowing base gets higher. In some cases, there's no personal guarantee, only what's called a Fidelity Guarantee, in which case you guarantee the honesty of the receivable, not the collectability. But asset-based lending can be expensive, and it may even require some personal guarantees, and it has its limitations. So there are additional sources of lending that are out there, and one is called the Small Business Administration. Last year, the SBA made more than 30,000 loans. How does the SBA work? When a bank rejects you, the SBA will step in and they'll guarantee on average 85% of the risk to a bank, making that bank a lot more motivated. SBA loans always require personal guarantees, and they look for credit, collateral, and character, and we'll be happy to help you find an SBA loan, but it has its limitations. There is a fourth kind of loan called mezzanine lending, and that's where the lender takes more risk at a much higher rate. Mezzanine lending can be as much as 12 to 18% per year, and it can stand behind a bank or an asset-based lender. But if you're going to grow your business, you need more than debt. You need equity. You need people to invest, or companies to invest in your company where you don't repay the money, where there is no interest, and where you have growth potential. And one of the obvious choices is venture capital. You can't provide venture capital to Harry's excavating company if you're not glamorous. But if you have an exciting product, breakthrough technology, a rapidly growing company, venture capital is a possibility. The cousin of venture capital is called an angel investor. That tends to be an individual who will invest in a business, maybe not quite that glamorous, but something that the angel knows. Angel investors invest as little as $100,000 and as much as $5 million. The third source of investment is called private equity. In private equity, all things being equal, the private equity company wants to take a dominant or majority share, but there are some exceptions. That money comes in as equity, but the good part of it is a lot of that goes to you as a liquidity event. And finally, you can consider an IPO or initial public offering. But probably a real full-blown IPO is outside of your potential. You need to have a super company or a breakthrough concept. There is an offering called a SCOR, SCOR. It stands for Small Corporate Offering Registration. And there you can raise $1 million with a minimum amount of red tape. It's an intra-state offering. You file a document called a U-2 in your state securities capital, and generally within 30 days you're authorized to sell stock. And amazingly, you can go on TV, you can go up and down the street, you can sell your grandmother. There's no limitation. We like SCORs, especially if you have a constituency. If you have lots of customers, lots of clients, lots of employees, lots of people who will want to do it. And finally, the last form of raising money is called a private placement. And that's where you can sell securities, or debt to up to 35 qualified investors. And a qualified investor needs to be earning $250,000 a year and have liquid assets of $1 to $2 million. But with a private placement, you need to have a prior relationship with that investor. You can't put an ad in the newspaper or go on TV or up and down the street. So we've mentioned a great number of ways to raise money. They run the gamut from banks to the SBA to private equity to venture capital. We're involved in all these areas of raising money, and with your collaboration and support, we'll choose the appropriate way to raise money. It's not that one size fits all. You have to choose the appropriate methodology that fits your company, your goals, and your needs. If you're going to raise money, we need to do what's called an independent appraisal to determine the value of your business. Or if you are a startup business, what is called a pre-cash evaluation. We need to write a profile on the company, and we need to approach the constituencies of the market. But if you'd like to raise money to grow your business, it is an art science where experts in the raising of money will take you by the hand, will establish the right methodology, will point you in the right direction, will handle the negotiations, and will be with you from concept to closing. We'd love to help you raise money if you're qualified. We'll tell you pretty quickly if you can qualify or not before you spend a penny. Please call us at 954-586-1000. That's 954-586-1000. We'll help you raise all the money you need without losing control. Thank you very much.